So I guess we'll start, obviously, with the boring stuff before we really dive into volume weighted average price. I graduated from Tufts University in 2008. What I always joke is a perfect time to start trading. And I say that kind of grimly, of course. It really was both an excellent time to learn to trade and also a terrifying time to learn to trade. It's kind of like learning to surf during a tsunami, of course. I kind of started out of necessity, to be honest. I was getting ready to be an English major, and at the very last second, for an economics course I was taking, probably in my late junior year, I was writing about systemic banking crises. This was going into the time when Bear Stearns was quite sick and, of course, collapsed in, I believe it was March of 2008. So something told me maybe I should consider actually electing for an economics major instead. Obviously, any of you guys who know anything about economics know it didn't really help me in trading as much, but it definitely got me interested in finance more broadly and the markets, something I've been kind of passively following for a long time, but chose to make a career out of. I recognized that I was going to be kind of competing with, Lehman Brothers and Bear Stearns and Goldman veterans who were coming out of the institutional finance sphere. And I realized that the best experience I could probably get was opening a Thinkorswim account and losing a little bit of money while I was still in college. So obviously, I'm half kidding there. It was a great experience, and I'm proud of the fact that I only put the minimum amount in when I was starting. So that was my first foray into risk management. There's a dorky picture of me so you guys can kind of imagine who's talking to you at the moment. I've been an active equities, futures, and options trader since 2008. I've really focused on equities the entire time. I did about 5 to 7 years of active futures trading, and I still dabble from time to time, about the same amount with options. I am very literate in options trading, so if you guys have any options related questions or how VWAP and technical analysis can relate to the sort of options sphere, totally fine. I would tell you I'm familiar with Black-Scholes and Bjerkson-Stensland and binomial, but I probably am not going to be doing any math in my head. So that's the sort of limits of my technical expertise with options. Are most of you guys options traders? Did I hear that correctly?
Yes.
Yep. Cool. And the interesting thing about options I've always found is options traders are kind of cool hybrids of technical traders because you're still reacting to the chart and the underlying delta movement. That's obviously what most options traders are kind of keying in on, but with a more sophisticated expression of the thesis. And obviously that's where theta, gamma, vega, et cetera, and even rho occasionally come in play. I've been a volume weighted average price specialist since 2011, 2010, 2011 or so when I first discovered it. And it revolutionized my trading personally. I always tell people I feel so much respect for VWAP and kind of an affinity to this technical tool just because it saved me as a trader. It helped me to make sense of the markets, to take what was otherwise chaos and give me clarity. And I mentioned my dog before, but I live in Cincinnati, Ohio with my pup, Blue. She's a German Shepherd Husky, and she's a great trading partner, except for when she distracts me in the middle of a trade, and I have to explain to her, no, Daddy's got a lot of money on the line. I can't take you outside right now, of course. I founded the VWAP.com in 2016, where I've coached 500 plus retail and proprietary traders on 6 continents. If any of you guys know anyone who needs technical advice or wisdom who lives in Antarctica, I'm truly looking to make a clean sweep. And that sounds like a dorky joke, but I'm dead serious. I'm going to find somebody at a research station who's looking to trade. Can't imagine what the internet connection is like down there. But I would love to be able to say I've truly coached worldwide. I've probably had conversations with several thousand traders, and that's part of my next bullet point. Which is that I was featured on the Chat with Traders podcast 3 times, the most of any guest, in episodes 11, 25, and 50. So after you guys listen to me here for a half hour, 45, maybe an hour, if you, for whatever reason, want to go listen to several more hours of me rambling about my backstory, they're available on the Chat with Traders site. That is a picture of me from several years ago, back when I had a giant TV mounted over the top of my iMac. I've since upgraded, and I wanted to put a more recent picture in there, but I'll just have to describe. I basically replaced the laptop on the right and the monitor on the left with two giant 4K TVs. And a small, totally non-VWAP related note I'll make to you guys. I cannot speak highly enough of getting, cheap but big TVs rather than monitors. What I found is that computer monitors, while they're great for, let's say, high resolution video display or photo editing or even video gaming, why would we need that for trading? We're displaying red and green boxes, and we need as much screen real estate as possible. So I am, as you can see from the picture, kind of a proponent of having quite a few monitors at any one time. Screen real estate is critically important. And you can actually see, if you look closely enough on here, right in the center and up at the top, plenty of VWAP charts. Obviously not in enough detail to make any sense out of it, but this was taken back in, I want to say, 2014, 2015. So a couple upgrades since then, but definitely still approximately the same charting. And obviously, most of you guys would recognize this as Thinkorswim. So with that, we'll kind of dive into the boring what is VWAP for those of you who don't know. I'm kind of assuming that most traders who are listening here have maybe a basic working knowledge of technical analysis, but maybe aren't necessarily familiar with volume weighted average price itself. The key thing is that VWAP is a reference point since some event. And most traders who hear about VWAP are going to hear about it and think of what I call plain or intraday or normal or vanilla VWAP, which stems from the start of the U.S. market open, 9:30 a.m. Eastern, and goes all the way until 4 p.m. It originally started as an execution benchmark, something for institutional traders to judge themselves against, to figure out if their large position that they're working to fill throughout the entirety of the day is a better or worse price than the market's average price across the entirety of the day. You can kind of imagine it would be unfair if someone said, well, you got a worse price than the 20 moving average. And you looked at them and said, the 20 SMA, why are you judging me against that? That only looks at the last 20 bars. And we don't even know what size bars we're talking about. Are you talking about a 1 minute chart, a 5 minute chart, a 15, a 30, an hourly, a daily? It just leads to a lot of confusion. Now it's a piece of technical analysis in the sense that we sort of retail or independent traders can use it as dynamic support and resistance across the chart. Like I said, it's typically intraday, market open to close, but it can be applied to multi-day. I could go off on a kind of nerdy math rant here, but the idea is simply, if we have some valid math that applies to a short-term market move, we can apply it to a medium or a longer-term market move, and the math works the same. That's the beauty of the cumulative nature of VWAP, which I'll talk about in greater detail in a second. But periodic technical analysis, things that look back X number of bars, so that'd be like all moving averages, MACD, RSI, stochastics, CCI, ADX, most of the technical analysis that spans the gamut, that's all periodic in nature. VWAP, by contrast, is cumulative, and it represents the true average price from some critical event. So up until now, we've really only talked about it as, like I said, market open to market close, but we could stretch VWAP to span more than one day, or in fact, many days. I mean, perhaps weeks or months or quarters or years even. And the way I often describe it to people is intuitive, otherwise hidden support and resistance. And that's pretty much what we technical traders are really looking for, right? We're looking for where the market actually would describe its own support and resistance, rather than our discretion in placing it or drawing it or tweaking or calculating it on the chart. To the point of the calculation of VWAP, and I promise we are not going to get very mathy here. We probably could, but the essence of it is really all you need. It's total money divided by total volume. And And the way we'd compute total money is taking the average of each bar times the volume for that bar, sum that up over the entirety of the day, and then divide by the total accumulated volume. And the way you can think about this is it's just like a dollar cost average. If you were to purchase at 3 different parts of an intraday chart for 3 different amounts of money, you would basically add up the amount of money you've spent in total and divide by the total number of shares you own. And that would give you your average price. So it's a very kind of familiar concept, but it looks and sounds a little scarier when I describe it in the proper sigma notation that VWAP is often sort of written out in Wikipedia. If you go look up the computation of VWAP, you'll see some scary looking math by contrast. Then again, you guys are options traders. You're probably a little more math savvy than the average equities guy, right? A common misconception about VWAP is that it is just another moving average. Part of the simplicity of VWAP part of VWAP's strength is its simplicity, but it often gets mistaken or treated just like any other SMA or EMA. And as I was raving about before, it is cumulative, not periodic. We'll get to some of the benefits specifically of that, but that's the most important thing to remember about VWAP. VWAP is not the same as a VWMA, a volume-weighted moving average. And I've highlighted them with slightly different colors so you can see that the moving average part and the average price part, though sounding the same, are really not the same. And another question I commonly get when I'm teaching someone about VWAP is they say, well, Zach, it's got to be the VW part that really creates the character of that line, determining how it's moved. It's got to adjust for the amount of volume that's being experienced by the market. It'll move more when we have higher volume and less when we have lower volume. And while that is correct, it doesn't really capture the essence of why a VWAP moves in the way that it does. Most of the behavior or the kind of computational effect is the fact that we're dealing with a cumulative average rather than a periodic one. The volume weighting is just it's kind of like the seasoning to the soup. It's not the base of the actual dish. It's just a little bit of salt or pepper that you add on at the end. So it's kind of a misconception that the volume only factors in maybe 15 to 20%, not 80%, let's say. 80% of the behavior of a VWAP is because it's a cumulative average. And one of the neat things about it being cumulative is that it's not susceptible to changes in type, length, nor time frame of chart. So what that means, and we've all probably experienced this before, someone says, hey, take a look at this chart. I've got a 20 moving average on it. And you look at the chart and you say, well, is that a 20 simple moving average? Is that a 20 Wilder's weighted moving average? Is that a whole moving average? Is that exponential? What are we talking about here? So that's the type of average. The length of average is, of course, the number of bars over which it's calculated, 20, 50, 200, whatever number you choose. And then finally, the time frame of chart. Since we're calculating a periodic average over an X number of bars, we're unfortunately susceptible to changes in the size of the chart. We've probably all seen this before. If we pick a really good moving average on a 5-minute, and then we change to a 15-minute or a daily, or back to an hourly, then a 1-minute and a 5-minute, we're going to get a bunch of different sort of answers as to what signal we're receiving from the average. This, and I'm sure we've all experienced this before, we've had to tweak or calibrate the average to fit to the chart. And there's probably a red flag going off in everybody's, the back of everybody's brain when they do that. They say, I'm kind of curve fitting here, aren't I? And not only literally curve fitting, you're kind of metaphorically trying to find, of course, the appropriate, type, length, and time frame of chart to fit with your analysis. And that should, as I said, send up a red flag. Something else we're going to cover is standard deviations, which I'm assuming everyone's probably seen before in the sense of Bollinger Bands. Bollinger Bands are different from a moving average and standard deviation set in that Bollinger Bands are centered around a periodic 20 moving average. The standard deviations that we're going to use are appropriately cumulative. So they're going to grow throughout the entire span of the day or the chart over which we're calculating them, rather than opening and closing like Bollinger Bands. This gives us kind of an objective or tailored way of gauging how far we are from the average. It really isn't fair to just use a dollar distance away from the mean, because some stocks are big, Tesla, some stocks are small, General Electric. So a $1 distance from a VWAP, that's not going to cut it. And most traders, when they hear me say this, kind of offer, well, what about percentage? I mean, that should account for differences in size of stock. That's obviously true. However, some stocks are high beta and some stocks are low beta. So again, using the example of, let's say, Tesla versus General Electric, it's pretty common for Tesla to move, I used to say this and I would say, oh, Tesla's going to move 5 or 10 points a day, but now I feel like it moves 5 or 10 points a minute. Whereas General Electric is maybe moving, 50 cents, $1 on a volatile day. And that percentage of the stock's price is going to be very different. So we need a kind of idiosyncratic way, a stock-specific way of gauging what's typical for a stock to move away from the average. That'll kind of help us to discern the difference between trend and non-trend, concept we'll get back to in just a minute. It helps to thematically organize the chart. I know I haven't shown you a chart yet. We'll get to that on the next screen, and then I'm going to go through a couple more examples. But like lanes on a road, as I describe it, the analogy here is great because when we picture, let's say, a 2-lane road in either direction, so there's a fast and slow lane for each direction of traffic, without knowing anything about the road, because we're all familiar with the kind of broad framework or I want to use a dorky word here and say the taxonomy, but the sort of format or framework of what the road, of what any road should look like. We are able to understand the kind of position of cars on the road and what their intent is. We know what the fast lane is. We know what the slow lane is. We know what a car crossing that middle lane, the kind of double yellow, would signal. Signals, hey, be really cautious. There's some sort of major shift happening in that car's position. Standard deviation bands are going to plot for us something that is visually kind of similar to lanes on a road, a familiar framework, if you will. And then, as I said, we're trying to dramatically improve our detection of trend versus non-trend. I think a lot of traders get lost in the battle between bull and bear. They look at the market as, I have to figure out if I need to be long or short, up or down. And that's almost the wrong kind of binary question to be asking. Earlier in the presentation, I think I was saying, VWAP I feel such an affinity to because it made sense of the market when nothing else really could. VWAP asked me a question, not literally, of course, kind of metaphorically. It forced me to ask the question, I should say, of, is the market moving outward and away from the average? And notice I didn't say long and I didn't say short. I just mean outward in either direction, either strongly up or strongly down. Or is the market kind of waffling, chopping, and stuck sideways within its typical zone of oscillation? That to me is the binary question that traders should ask themselves. Is this market moving? Or is this market struggling and not moving? Then we'll kind of move on to what can VWAP do for your trading. As I said before, I know don't have a lot of charts in here so far. I've got one example chart in here, and then I believe the next slide we're gonna switch around and go to Thinkorswim and maybe show you guys a couple live examples of some of my studies in action, and happy to obviously look at charts or use the studies in that way. So we'll make sure we get to some examples here in a second. A phrase I have repeated a million times: detection, not discretion. What VWAP kind of enables us to do is figure out where the market determines support and resistance to be located or calculated, rather than tasking me or any trader with drawing it on the charts. I don't think I need to lecture you guys about the challenge of misdrawing a trend line or using, let's say, a moving average from one chart on another. Oops, sorry, I was getting a little echo there. I think we're good now. But, avoiding discretion wherever possible is probably a good answer for traders, simply because there are so many ways in which we can screw this up. The more we can leave it up to the computation and out of our hands, probably the better. I am going to talk a little smack about moving averages here, only because I believe that a VWAP is more objective than a discretionary moving average, simply because we're going to be trying to launch it from a critical event, which is a singular point, rather than leaving it up to all the kind of tweaking that I was referring to before, all the choices in type, length, or time frame. Those are common pitfalls for developing traders. As I just said, little user influence beyond placement. That's a common objection to a volume-weighted average price. People will say, but Zach, there's still some user control over where we choose to launch a VWAP or anchor a VWAP or start a VWAP. One of the things I go over in greater detail in my VWAP course is sort of the checklist of where we're looking for to launch VWAPs. There's no one best point, but there is a kind of usual suspects list. And by the way, I'm 34, so that usual suspects, I often try and ask, hey, anybody seen that movie? And most of the people I coach, they're in their early 20s, they say, what the hell is that? I say, classic movie. But we're looking for the usual suspects of anchor points on a multi-day or swing-based chart. We'll get into that in a little more detail when we get to the event VWAPs section. But because VWAP is incorporating volume, it's kind of reflecting where other people are willing to commit their money seeing value on a chart. And that visualization of time and price and volume all in one kind of streamlined, simplified indicator is very compelling. One neat thing is that it can give you an aggressive kind of early warning signal. As I described here, a tipping point for character change. What VWAP enables you to do is not have to wait for a market to break out beyond a prior high or a prior low in order to signal some sort of aggressive move. A VWAP will form fit to price a little better than the standard, let's say, trend lines or horizontal support and resistance, pivots, etc., giving us a bit of an advance warning. It also helps with obviously rapid assessment of any chart. As somebody who has coached a lot of developing traders using this method, the thing I always come back to is traders need repetition. Traders need to be able to see a similar or familiar framework over and over again to build confidence and competence in pattern recognition. As we said before, trend versus non-trend, not long versus short. That is the question I would challenge everyone to ask themselves when they're looking at a chart with volume-weighted average price. Don't worry about should I be a bull or a bear, but rather is this market retreating, kind of magnetically pulled back inwards towards the VWAP? That would be non-trend. Or is it magnetically repelled, let's say, away from the average? It gives us, like I was saying, a consistent visual framework to make pattern recognition a little simpler. So as we were talking about before, here's our centerline volume-weighted average price following throughout the day, and I've custom colorized it to be yellow when it's rising, kind of a magenta or pink when it's falling. I think the average person can probably detect slope with their eyes pretty easily, but it certainly helps to make the market crystal clear when we've got a rising average price versus a falling average price, what type of regime or trend environment we're in. As I mentioned before, we've got the standard deviation bands in either direction. The dashed lines represent one standard deviation, the solid lines representing two standard deviations. And you may recall from just a minute ago, as I was referring to, these aren't really Bollinger Bands. They are 1 and 2 standard deviations, but they're not periodic. So they're not going to, let's say, open and then close, and then open and then close throughout the course of the day. They tend to have a generally expanding behavior. And you can see that the distance, let's say, between the 1 deviation band and the 2 deviation band is very small earlier in the day. Quick question here. When I'm drawing on the charts, can you guys see that, or is that not coming through in the screen share?
Yeah, I can see it.
Okay, awesome.
Yep.
Just making sure. So early in the day, we've got kind of a very small standard deviation range. In the middle of the day, it's grown quite a bit. And we can actually see as the market's sort of volatility develops, by the end of the day, and I'm going to have to measure from a different one because that one actually rips off the screen, but the size of a single standard deviation is, many multiples of what it started out. This is actually LVGO from yesterday, and it's on a 1-minute chart basis. So anybody who's got their Thinkorswim open with a basic VWAP, feel free to pull this up, or obviously if you're watching this on the recording, go ahead and take a look after. But you should see it's very similar behavior. Just to clarify too, this is a custom VWAP that I've coded with some kind of additional colorization to highlight when we're greater than 1 deviation away from the VWAP in either direction, as well as the slope or directional slope, I should say, just up or down of the volume weighted average price, as well as I've added in the 1 and -1 deviation band. Draw that a little cleaner. Here we go. If you'd want to, and I'm only saying this because I know there are quite a few traders who are probably listening to this who are on Thinkorswim, a way to cheat and kind of pseudo replicate what I've got here on the chart is to add a second copy of the basic VWAP study and adjust that one so that the deviations are not 2 and -2, but rather 1 and -1. And if you want, you can go into the plots tab and adjust the kind of style of those lines to be dashed lines as well. And I just say that so people don't have to wait until they decide if they want to pick up the custom VWAP from my site. They can approximate it on their own for free right now. Whoops. Of course, it rotates kind of weirdly there. And moving on, dynamic adjustment for higher or lower volume and volatility. Something that's great about VWAP is that it incorporates volume without us having to do anything to account for it. We don't have to enter any manual values. It kind of automatically detects and, as we just went through here, expands throughout the course of the day to account for that additional price movement. For example, if we had preset or fixed deviation values that never grew or changed throughout the day, we would have a very hard time observing dynamic resistance at around this little reversion or pullback to a declining -1 deviation band. This is something I cover in a lot more detail in my course, but this is one of the trade types that we're looking for. A market that has expanded into what I call the fast lane. It's the area between the -1 and -2 deviation band. And of course, there's the fast lane on the upside between the 1 and 2 deviation band. But then retreats to a trending 1 or -1 deviation band. That's a great resumption of trend point, something I call a continuation trade. And I created this because I can't tell you how many times I missed out on these kind of trades early on in my trading career. I'd be looking for something to cross the VWAP, and if I didn't enter that trade early, aggressively, and right on the nose, I felt like I was left in the dust. That was incredibly frustrating come, 3:45 p.m. I'm looking at LVGO down here and saying, how in the world was I supposed to get aboard this trade if I missed that one transition point when we were crossing what was support and then now has kind of crossed and become resistance? The standard deviation bands help us tremendously by giving us kind of extended or more aggressive resistance in a market that isn't strong enough to revert all the way back up to the downtrending volume weighted average price. And that's why I call it a continuation trade. We've already made a bit of a breakdown. We retreat back to our continuation point or our aggressive trend resumption point, the -1 deviation band in this case, and then we are off to the races. Simplicity. As you can see from these charts, I really don't have a terrible amount of information on the charts beyond the volume weighted average price, the deviation bands, and then a little bit of custom colorization. I've actually gone so far as to remove the background grid lines from the chart that show you, the sort of round hour numbers or the half and whole dollar numbers on a stock's price, because I want absolute minimalism. I want to be able to see the intersections and the kind of respect of price action with the VWAP and deviation bands themselves. Intraday VWAP is something that is common across all equities charts. So no matter what you're looking at from the start of the day until the end of the day, that's your plain, normal, vanilla, whatever you want to call it, your typical VWAP. When most traders say the phrase VWAP, this is what they're referring to. And then there's something that I refer to as event VWAPs or multi-day VWAPs that are rarely occurring but fairly obvious. And without diving into a ton of detail on them, things like a volume weighted average price from a recent earnings event, a volume weighted average price maybe from a high of the day or a low of the day, price extremes. Maybe we're going to measure it from a high volume bar or a major gap that occurred on a daily chart. Event VWAPs are going to be, as I say here, few and obvious. So a common kind of objection would be, well, Zach, if you can launch a VWAP from anywhere, how the hell am I supposed to figure out where I'm going to launch the VWAP from? And that goes back to my totally terrible joke about the usual suspects. Regardless of the chart, we know kind of a checklist of where we should be looking for a volume weighted average price launch point. So I just rattled off a couple of them, but just to reiterate, earnings, gaps, high volume events, geopolitical or macroeconomic events, data release, stuff like that, as well as a few more. And another neat philosophical point about this, VWAPs have inertia and change direction rarely. So they're going to give you relatively few signals throughout the day. I should also clarify that these arrows are not the only signals that we're looking for. These were just a couple relatively obvious bits of dynamic support and resistance that I wanted to highlight for you guys in this presentation. When I say VWAP has inertia, notice that it tends to continue or persist in its uptrending behavior until a major cross occurs, at which point it reverses direction. That's another benefit to my common nemesis, moving averages. Moving averages, especially short-term moving averages, are going to give you a lot of signals, the benefit of which is that they're very responsive. You're going to get a quick response when a trade breakout or breakdown occurs. The trade-off for that is that they are relatively low credibility. VWAP, on the other hand, is the kind of dynamic opposite of that. It's less responsive, but it's significantly more credible. When a market crosses a VWAP, I implore you, pay attention. So with that, I'm going to hop to my Thinkorswim and we'll get some example charts here. What I've listed are 4 studies that we're going to take a look at. Intraday VWAP and standard deviation bands, something we've already looked at for a second. Date or anchored VWAP, and that's giving the user control over the date and time where we launch a VWAP. High VWAP and low VWAP, which are just my nicknames for launching from the highest or lowest point of the chart. And then event VWAP, something we just discussed a second ago, earnings, gaps, etc. Bear with me one second as I figure out how we're going to, I think if I select this. Now tell me, are you guys seeing the Thinkorswim chart?
Yep.
Awesome. Yep. Okay, just making sure. So here I've pulled up a chart of the QQQ ETF from the last several days. I'm going to zoom in horribly at first, but then I'm going to zoom in on just the last 2 days of price action. Obviously, yesterday was a monster move to the downside. Today was a relatively tepid move back up, but both days showed a lot of clean and interesting VWAP behavior. So the areas of the chart that I draw your attention to, and again, we've got our standard volume weighted average price, our 1 and -1 deviation band, and then our 2 and -2 deviation. And forgive me for drawing with my mouse. I know it looks like a 5-year-old with a crayon drawing on the wall. But the areas of the chart that I draw your attention to are very simple. Look at how the market moves from a relatively sideways or non-VWAP sloping environment to one of an attempted breakout. This is highlighted by the kind of light green color as we surpass 1 deviation, moving to the upside. When the market retreats from that outer fast lane environment back down into the slow lane, as I call it, notice there's 2 attempts to sort of merge, if you will, back into the fast lane, both of which are stymied pretty quickly. There's no follow through. After we collapse down through the volume weighted average price, we actually find dynamic support right at the -1 deviation band. So up until about, let's see, it's about 1 or 1:30 on the chart, maybe 1:15 Eastern, right where my cursor is, we've really only seen an attempted breakout, kind of tepid failure, and then an oscillating retreat with a very flat volume weighted average price. So notice up until about here, we really would probably be expecting non-trend behavior. If the market were to have continued upward and out of the 1 deviation band, that would be trend to the upside, and obviously downward would be trend to the downside. We really got neither of those.
Hey, Zach.
Yeah.
I'm not sure if I'm the only one, but I just see the chart. I don't see any of your cursor or if you're drawing on the screen.
Goodness. Okay, well, I appreciate you telling me that. That's interesting.
No problem.
So here's what I'll do then. I'm going to switch away from drawing with this application. And I know exactly what's happening now. I appreciate you chiming in and telling me that. I'm using a drawing application that sits on top of the screen rather than it's within Thinkorswim. So I'm glad you mentioned that. And here's what I can do. As a matter of fact, I'll just draw within Thinkorswim. It's going to be a little messy, but we'll make it work. As I was referring to before, the highlighted portion of the chart is where we experience kind of an attempted breakout. During the middle section of the chart, this hideous oval that I'm drawing here, making do with Thinkorswim, this is what we'd kind of anticipate as the non-trend or the choppy behavior. Notice that this is bounded between the 1 deviation band on the upside and the -1 deviation band on the downside. As I was saying before, if we broke into the fast lane going lower or the fast lane going higher, that would be my kind of clue that we're experiencing atypical or trend activity, for lack of a better word. And I do understand that a proper trend is defined as higher highs, higher lows, probably much more rigorous definition than what I'm applying, but I'm just trying to broadly characterize movement away from the VWAP versus what we've highlighted here in the oval, which is movement sort of stuck back towards the VWAP. Let's go ahead and clear this as well. And then, whew, one hell of a day to describe this on. As soon as we break materially below -1 deviation band, this is like, for lack of a better phrase, the gates of hell have opened up and swallowed us to the downside. We get a significant directional move as soon as we break below the -1 deviation band. And notice that the flatness of the volume weighted average price kind of shifts into a trending or directional environment as well. I'm just going to highlight this with my cursor, but the second half of the day, or the latter third of the day, I should say, is a clear directional environment. Kind of to the same point as we were making on that LVGO chart, when a market retreats back to a sharply declining deviation band, that is often an excellent place where you can participate in a trade you may have missed out on. I got to tell you, I was not kidding about I've missed 1,000 of these before I ever figured out I don't need to wait for the market to come all the way back to the volume weighted average price. I'm better off finding an extended or aggressive reentry point as kind of a compromise between chasing the market when it's at its lows and patiently waiting for a reversion all the way back up to VWAP, which just simply isn't going to happen during a strong sell-off or a strong uptrend. Before I move on, just because I've been rambling at you guys for probably already 30 minutes, do you have any questions about the chart thus far?
Nope. I think you're doing great. I'm saving a couple questions for the end, but.
Okay. Just making sure people weren't like, what the hell is this guy talking about? I got a million questions already. So here we are on the current day on the Qs, and notice the kind of dynamic support that we find over and over and over and over. It doesn't quite touch in this last instance, but at the volume weighted average price itself. It's a common point of retreat, the mean in mean reversion, as I've said before, right? It's the area to which we are likely to pull back during a trend that will likely be defended if the trend is significant. If the market had deeply crossed or oscillated below volume weighted average price, and then perhaps back above it, and then back below it again, you can imagine that kind of choppy behavior is what we look for in non-trend or counter-trend reversionary trading. By contrast, what we see here, and forgive me, I'm going to remove these drawings real fast. What we see here in the kind of highlighted circles is safe areas where a position or trend trader can lightly re-add to a position or add back into a position having stopped out of it, or build a core position if they believe the market is ultimately going significantly higher. So that's intraday VWAP and standard deviation in a ultra quick nutshell. I know we're probably already running over on time, so I'm going to have to move a little quicker here. But this next chart, I'm actually going to see if, I'm going to actually set this to a much longer look back period. So what we're looking at now is a Facebook chart, 180 days at a 30-minute granularity. And I've done that just so we can see the entirety of the coronavirus crash and then the resumption back to the upside, as insane and perhaps improbable as it may have looked. What's neat about this study, and this is the date VWAP as I call it, or the anchored VWAP as many people refer to it, is we have complete control through the study's parameters over where we want to launch the VWAP. When I open the customization window, is it sharing the inputs for you guys, or is it still just on the chart?
Yeah, it's sharing it.
Okay, perfect. Just making sure it wasn't cheating me into one window again. So we have a couple different methods through which we can display this. We can either enter a YYYYMMDD date format and a start time, or we can offer a number of days ago. The reason I've coded it this way is because I found that some charts, particularly short-term charts, it's way faster to type the number of days ago, maybe 3 or 5 or 20, than it is to type in the raw date and time. But when we are anchoring it to a fixed, an occurrence, an event on the stock's history, for example, in this case, we've chosen March 18th, which is the day the tech sector kind of bottomed just ahead of the broad market. In this case, we want to actually explicitly anchor it and not count the number of days ago, which, where we'd like the VWAP to launch from. Part of the neat behavior here, as I zoom in on this chart, is again, we're seeing something kind of similar in the sense that the market can't break below into the, come on, drawing tool, there we go, can't break below into the lower fast lane. The deepest it can get is but one deviation below the average price. It's like saying a market may oscillate around its mean, but it's not going to move atypically or uniquely or kind of scarily to the downside below that average. A market that can't get below one deviation to the downside is certainly not trying to sell off that aggressively. And if we look, there is only 1 and then 2 retreats below the volume weighted average price launched from the actual low. The entire rest of the chart exists above the volume weighted average price launched from that major turning point. And one kind of common objection, and just something I want to dispel, it's not that we would necessarily know on March 18th to launch a volume-weighted average price from that event. But several days later, as a method of confirming or measuring an area which must hold to the upside in order for a strong bullish trend to continue, VWAP doesn't always have to be a momentary kind of in-the-moment tool, especially when applied to hourly or daily charts. It can be used for kind of confirmation. And I didn't even make a note of this when I was looking at this chart ahead of time, but I can see that we've got that same kind of continuation behavior, bouncing or finding support off of that rising trending 1 deviation band. Even here, as we pull back into earnings, we don't quite make it back to the deviation band, but it looks like an attempted retreat before we catapult up off near the rising deviation band. And even here, over the last day, a sharp pullback, again finding tentative support at the rising 1 deviation band. The next study we're going to look at, that's actually the drawing from just a second ago that we were highlighting there. The next study we're going to be looking at is something that I call the high-low VWAP. And this is actually available for free on my website. So for anybody who's interested in playing with this utility specifically, all you got to do is enter your email address on thevwap.com. We have a little banner up at the very top of the site. And I believe it'll either email you or prompt you to download it right away, and you can install it into your Thinkorswim. This study will kind of give you control over quickly finding or detecting the highs or lows of a given trading day and automatically launching a VWAP from that price extreme. Notice again, I'm just on a Facebook chart, this time a 20-day, 5-minute chart. So we're just examining kind of a slightly shorter term, but still more medium term than a scalping or day trading chart necessarily. And this just happened to be something I observed when I was picking out example charts for today. Launching a high and a low VWAP. So in this case, again, from the actual price extreme, the highest point of the chart, and the other price extreme, the actual lowest low of the chart, we are able to automatically develop kind of macro support and resistance. I want to call them dynamic pivots because I keep overusing the phrase VWAP so much, but that's really what they kind of behave like. They are moving macro support and resistance, for lack of a better phrase. If we were to type in another chart, what you'll notice is that it'll automatically go grab the highest high and lowest low of the chart, and again, auto launch a VWAP. So does anyone want to just rattle off a ticker?
Shop.
There we go. I was gonna say, this is the pick a card, any card part of the presentation.
Yeah,
again,
you have a position on shop?
Full disclosure, I'm
Not
really,
anymore.
Really... Gotcha. So yeah, so we just typed in shop, and you notice that I didn't recalibrate or set the VWAP to do anything differently. It just detected where the highest high was and the lowest low of the chart. If we were to maybe change the time frame, so again, we'll go to maybe 90 days at a 5-minute period. We may have to zoom out quite a bit. Yeah, well, let's do this. Let's do 90 days at 30 minutes. And there we go. We're able to see that it'll again detect the lowest low of the chart. Again, the highest high is the same as it was before. But the high-low VWAP can be really useful on everything from a kind of a short-term intraday context, a 1-day, a 5-day chart, all the way up to probably a 90, a 180, or even a yearly chart, depending on your time frame. And then the last study I wanted to show you guys is something that I kind of obviously call event VWAP. Event VWAP is really nice because it does the kind of thematic opposite of date VWAP. So date VWAP, what we talked about just a couple charts ago, is basically letting the user have absolute control over the date and time of the launch of a VWAP. Event VWAP, by contrast, is going to do almost all of the work for you. So all you have to do is identify the theme you're seeking, and it will go find the events and automatically launch VWAPs from them. So in this case, I've set the event VWAP study to its earnings setting. Let's go ahead and pull up the settings here. So you can see I've got a number of options: earnings, highest, lowest, which we just kind of looked at, an automatic yesterday's VWAP, that's useful for a short-term trader, swing or dynamic VWAP, it's a little too complicated to describe on the fly here, but gap VWAP, which we'll take a look at again in a second, and options expiry, something I think you all might certainly get a kick out of. While set to the earnings setting, you notice that it's sort of identifying automatically where earnings dates have occurred and launching VWAPs from those points without any calibration from the user. So again, someone else, go ahead and shout out another ticker. First one wins.
Target.
There we go. And instantaneously, it's going to recalibrate and connect for us where those sort of elements should be loaded from, where those anchor dates exist. So this is built as kind of a time-saving utility for a trader who knows that they want to maybe more deeply understand anchored VWAPs, but doesn't want to go through the discretion of having to choose critical launch points based on that chart's idiosyncrasies. Kind of an interesting, this is not related to VWAP, of course, but I have to observe it. Interesting coiling activity on target. I know we just had the same sort of thing, I believe, on Home Depot recently. That's another trade I was watching. The event VWAP is neat because we can adjust it to something like a gap threshold. A gap threshold is the percentage value that a stock must gap in order to qualify for being identified for an anchored VWAP. So let's say we're looking for gaps greater than, I don't know, 5%, we'll just say. And it doesn't look like there are that many on targets. We may not find too many within, oh, actually, forgive me. No, it makes sense. During the March coronavirus crash, there were quite a few significant gaps that occurred. But what it's doing is it's looking backwards in time and finding the first or most recent gap event and launching a VWAP from there. And then going back in time and finding the next 5% or greater gap event, the next 5% or greater gap event, and the next 5% or greater gap event. Probably should have set a higher threshold, but same thing applies. If we rotate, so I'll just go John Deere. How about that? And again, it will kind of spit out a grouping of the latest 5% or greater gaps wherever they are on that stock. And just because we are mostly options traders here in this group, I'll go ahead and set it to OpEx. And again, we have the same thing, except it's tied to options expiry. So just to confirm that, we'll go and find expiration Friday and turn it on. And you can see that the expiration Friday is our now kind of dynamic anchor point. So as I said, our goal with this study, with event VWAP, is to take a lot of the pain out of having to manually go find these critical events to determine prospective support and resistance or trend behavior, these kind of dynamic pivots, as I call them, these VWAPs, and instead do a lot of the work for the trader. And just so you guys know, I probably got one more slide after this, and then we can get to the questions, because I know I've already run over on time. So bear with me 1 second here, and we will hop back. All right, and we're back on the presentation screen, just confirming.
Yeah.
Yes.
Cool, just making sure. And so I have a couple kind of, if you're going to be applying this sort of stuff tomorrow, what are some tips for using volume weighted average price? The first is that when in doubt, you should almost always trust the slope of VWAP as being your guiding force. In the event that you've got a flat volume weighted average price, that signifies a non-trending environment. If a VWAP is trending in one direction, that does not happen lightly. That's like an aircraft carrier turning in the ocean. That doesn't happen because a little wave comes along and bumps this 100,000-ton boat. That thing is turning because a lot of money, a lot of volume went into moving the day's average price. Like I said, VWAP changes direction rarely and only with significant price action and volume. You've heard me say this now 3 or 4 times, but I really want to triple underline it because it is absolutely critical. If we are focused on long versus short, we're really missing the bigger picture. If a market is stuck in a magnetic attraction, kind of a pulling back towards the volume weighted average price over and over, we need to adjust our expectations and our risk and our time expectancy for the trade. Particularly for options traders who are susceptible to some theta burn, we need to know when a market really is in a directional sort of environment versus a non-directional environment. And I use the analogy of magnetic attraction or magnetic repulsion because, you know, there are times when we would say, oh, it's attracted back to the VWAP. And we've all seen plenty of charts where it just goes and blasts off in one direction or the other. Magnetic repulsion, of course, being the parallel there. I would not count on or bank on reversion to the mean. This is another common pitfall for VWAP traders I've seen time and time again. People will say, well, we're really far from the VWAP. We've got to go back to the VWAP, right, Zach? I mean, come on, mean reversion. Everything always reverts to the mean. My challenge to that is that there's no guarantee that price comes to the VWAP. It's very possible that VWAP will come up to meet price. So that's why shorting something that is pushing outward on the 2 deviation bands, you know, aggressively trading above the 2 deviation band for the day, that's a very scary thing to do, even though it seems intuitive and totally sensible. The problem is that your target for a retrace, the VWAP, there's no guarantee that that's going to be in the same spot that you want to short back down to. It's very possible that the VWAP, which is dynamic and responds to price and volume, as the market is embedded or kind of remaining at that extremely high price up near the 2 deviation band, that will pull the VWAP up towards us, kind of limiting or inhibiting the amount of money we stand to make from a short reversion trade. And obviously, same thing on the downside. A really heavily sold stock may not pop back up like a cork underwater. In fact, it's possible that the average price depletes, decays, and trends lower to the point that any reversion that occurs is almost insignificant and certainly not worth the risk it would take to get there. And then finally, don't overcomplicate things. I know that the way I describe this and all the detail and all the different VWAPs, it's like, what the hell, man? I thought this was just a single line on my chart. Now you're putting deviation bands and event VWAPs, etc. I would tell you to start with just intraday VWAP if you're day trading. You certainly can keep it kind of simple and minimal until you get the hang of the trend, counter trend behavior, the deviation bands, etc. When you're launching event VWAPs, try limiting yourself to only 3 anchor or launch points, such that you're not trying to curve fit, in a sense, or carpet bomb an area with support and resistance levels. And then last slide here, because Adam is looking out for you guys, and he asked me to hook you up if anybody's looking for volume weighted average price education. I have a VWAP on-demand course, 8 hours long, and it includes 6 custom thinkorswim indicators that I use every day. Some of these we've gone over in this presentation, but very, very quickly. Obviously, tons of detail included in the presentation, in the course itself. And that's thevwap.com/TTD. And we've got a discount code TTD35 for 35% off. The last neat little thing I'll mention here, and then we'll kind of pause for plenty of questions or however many are here, is that I am working on a custom web application that scans for these VWAP trades, the same that I teach in the VWAP on-demand course every day, to appear in real time through an intraday VWAP scanner. I'm just in the beta testing phase right now. Our target launch date is around September 1st. So if you guys are interested, we do have a kind of sign up with your email here page on our website as well. And that'll get you another discount code for the early offer there. And with that, I will throw it to you guys for any questions, or Adam, if you're the questioner.
No, everybody can just chime in. And if anybody's got a question, go for it.
A quick question here. I was looking at some charts, and have you ever used the breakout of a sideways trend as an anchor point for the VWAP? If you had any much success with that?
Interesting. I can kind of picture that. Let me make sure we can still see. If I draw on the screen, everyone can see this, correct? It's not doing the hidden thing again?
I don't see anything at the moment.
Okay. If I'm drawing over top of it, perhaps not. I was just going to draw an example of it, but regardless. So you're describing, let's say, an oscillating market bounded between the 1 and -1 deviation band. And then eventually the market...
If I'm looking at, well, I'm not familiar with VWAP to actually say that, but I'm just saying, you know, one of the charts you had there, you were looking at, it was if you're looking at the candles, it was going sideways. It was got a support and resistance, bouncing between those 3 or 4 times, then it eventually broke to the upside. So I was just curious if you'd ever used that breakout from that tight support and resistance sideways market as a anchor point.
Sure. No, that is a great point. I'll tell you, I'll be honest, I have not personally used it, but I don't disagree with the concept. That makes quite a bit of sense. I think the benefit of, you know, a VWAP is you can obviously kind of tailor it to a specific part of the chart, so it doesn't have to be a major event. It doesn't have to be a price extreme. If you identify a certain either high volume candle or, like you're describing, a breakout point from sideways consolidation, you could launch or anchor a VWAP from there. The benefit is that that's going to give you kind of like a custom definition of trend layer. You know, dynamic support and resistance that should not be challenged if the trend is to continue. So that's a great thought, Mark. I'll definitely send you a chart after this with some follow-up on that.
Cool, thank you.
Yeah.
How many stocks do you typically trade or follow?
So let's say Zach without the scanner, and then Zach with the scanner. So I'll give you 2 different answers. Without the scanner, I probably keep tabs on 25 to 30 different stocks. I'd say maybe 10 to 15 are consistent from day to day, and then 10 or 15 are whatever the flavor of the day is. That could be something that I've been watching for a particular technical setup, something that's in play, particularly high volume, or you know, a news catalyst. So I have kind of a hybrid between familiar stocks that I watch every day, pretty obvious names, for example, you know, Apple, Microsoft, Visa is another one I watch quite a bit. Back in the day, I used to trade the oil stocks, ConocoPhillips, traded that a million times. And then, like I said, leaving some open to whatever's occurring throughout the day. So yeah, probably 25 to 30 different names that I've got a dedicated giant grid monitor that I'm visually watching and able to kind of visually keep tabs on throughout the day. So then Zach with the scanner, I'm actually watching through the technology we're building about 1,000 equities and ETFs simultaneously, but we're only going to receive alerts on maybe 100 to 150. And when I say alerts, I want to be really clear. These are not trade signals. These are just candidates. It's bringing to my attention in real time stocks that are either pulling back to and offering support at the VWAP, for example, or maybe rallying up into a declining -1 deviation band, similar to the LVGO chart or like the QQQ from yesterday that we saw during the presentation. So the scanner has really just radically changed the way in which I approach the markets, because I don't have to be visually responsible for them. It's kind of like having a stock butler that's every 5 minutes, it's bringing me new candidates and saying, sir, here's your caviar. And I get to choose from those best candidates which charts look the most palatable for me. And the neat thing is it's in real time. So I have a fighting freaking chance of getting in that trade when it's still reasonably low risk and offering, you know, great breakout potential or kind of continuation potential.
So do you primarily day trade or do you swing trade or what's your primary?
I am 95% day trade, probably 5% swing trade. I know a lot of day traders who say, oh yeah, I'm the same, but you know, I only swing trade when I screw it up really bad and have to carry a loss into the close. And I laugh, but kind of grimly, because of course I've been there. I think we've all been there. That's certainly not healthy behavior. Yeah, I rarely swing trade. I actually personally, I don't find myself to be nearly as good or as patient of a swing trader as I am good or patient of an intraday trader. I think there's also just a love for a single day's price patterns and a kind of contained behavior that I witnessed between 9:30 to 4 o'clock. Oh gosh, I'm thinking of one chart in particular. I know we've all got these like horror stories from our past, right? But there was a trade in 2014, 2015 that stuck with me and stung me so bad on a swing trading perspective. And for the record, it wasn't like a total disaster. I had made a great deal of money over the course of about 2 or 3 months swing trading this one stock. And of course, I became very, very biased towards that stock. And then one day after the close, they announced they were going to have to restate earnings because there were some accounting discrepancies, I think they referred to it as. Ugh, what a kiss of death. And so that overnight gap shook me quite badly and kind of reframed my focus much more towards intraday trading. So
do you sell to open, buy to open, or are you doing spreads? What kind of options are you doing?
Sure. I gotta be honest. I'm a fan of ratio spreads, like diagonals. Definitely spreads. I'm not doing naked options anymore. I used to be a solely directional trader. Traded my share of condors and butterflies in the day as well. I would say I'm not as good of, speaking a little out of my comfort zone here, but I'm not as good of a volatility trader as I probably could be. I'm definitely more of a delta and theta based trader. If I had to choose. But simple answer to your question, yeah, mostly spreads. And I don't, forgive me for this, I know I'm going against the great, Tom Sosnoff and TastyTrade's broad thesis of selling premium, but there are a lot of times, because I'm a technical trader, I'm making a lot of chart-based theses, there are a lot of opportunities for reasonable risk reward through directional spreads. And actually, to connect the dots, just while I was answering that, I was kind of pondering this. If we observe, let's say, a contained or choppy, non-trending market, so the opposite of what you'd want to take a directional trade on, right? You know there's a million idiots buying calls or puts on something that's not going anywhere. We can construct, like I was saying, a more sophisticated thesis that can benefit from being time positive, right? We can actually benefit from time decay by maybe a condor, for example, or a butterfly if the range is that tight. VWAP would really help in the sense that it would kind of dynamically define where a critical breakout or breakdown point would be for us to react and maybe adjust or hedge or leg out or close that position accordingly. So, VWAP doesn't have to just be utilized, and now that I'm kind of mentioning it, I probably should be trading options more. I realize that, of course, an hour into a presentation to a group of options traders, but there's a lot of opportunity in both the directional and non-directional or anti-directional behavior. Kind of a neat synergy between VWAP as support and resistance and identifying range-based trades with options.
I'll keep going if someone else wants to chime in, but I was kind of noting got some questions. But so on your indicator that plots the high point and the low point of the given time period that you're looking at, do you find that, let's just say the high point that it's plotted, that when the price breaks back above that is a strong directional signal for going long, or on the reverse of that, if it's the low and then it has a retracement and it breaks that low point that it's plotted, that it then becomes a strong directional short.
Absolutely, you nailed it. I kind of said it maybe in a very cryptic manner, but A VWAP should act as a definition of trend. So if we were to launch a VWAP from a major low point, and as Adam was just saying, we were to break back below that meaningfully, especially after several days or weeks above it, that's quite a bit of damage occurring to the kind of value defense of that stock. Anybody who believes that that stock is going to go higher would probably want to be buying it at the average from the lows. In fact, any reasonable uptrend should be defended at that VWAP from the low point. And so in that sense, earlier in the presentation, I referred to VWAPs as kind of an early warning signal. So we don't need to wait for a new lower price low to occur. Because the VWAP is going to kind of form fit to price more aggressively, trending up, 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 as we rally up off that low that you're describing. Whenever we break that VWAP, that's your first red flag of, wait a minute. The people who should be showing up to buy and defend this stock are really not defending this stock. If they're not willing to pay what people have on average since the low, well, that's not a good sign, right? That's like if you have a sale for your products and nobody shows up to buy it. It's like, crickets, chirp, chirp, be like, okay, this is going to be a problem, right? Any stock that doesn't see immediate, and I really do mean near immediate interest at or near a VWAP from that time frame's lows, that's definitely a kind of tipping over, looking heavy, ugly, like something is sick or sour or rotten in that stock. And it may attempt to breach the actual price lows from whence we launched the VWAP again. So great observation, Adam, definitely.
Cool. Well, so along those same lines, when you launch on an earnings with your indicator, is it taking into account whether the announcement was before market hours or after market hours? Because that would skew the volume to either that day or the next day.
It does skew slightly. I think we are just identifying the actual calendar date. I don't think we have an option for before market or after market. One thing I will observe, and this sounds like I'm kind of skating around the question, but it really is true, especially as the scale of a VWAP expands to be many, many, many days and many, 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 many shares. Changing, let's say, an 80-day VWAP to an 81-day VWAP. So, for example, this is, after market the day before or before market on today. If we're changing it from 80 to 81 days, we're really adding a tiny bit of data into a massive calculation. So that's like adding, 1 cup of water into an Olympic-sized swimming pool. Even though it's a high volume day and it's an earnings day, and a very significant day, it's really only minorly going to adjust or shift that aggregate calculation spanning, like I said, like 80 or many days. An important thing to remember to kind of acknowledge your point, though, is the shorter the time frame, I shouldn't say time frame, the shorter the duration or length of VWAP, the more susceptible it will be to that kind of behavior. Because then we're not dumping a cup of water into a swimming pool, we're dumping a cup of water into like a small pot that would sit on your stove. It really could be too much water or too little water. So back to analogize back to trading, that would be quite a bit of volume compared to the total volume over only the last 3 or 4 days, for example. So like I said, the shorter the duration of VWAP, the more susceptible it is to changing the launch point by 1 day. The longer term the VWAP, oh, that thing's like, yeah, whatever, but I got 1 billion shares already in my denominator. So 1.02 billion, cool, whatever. Sarcastically responding as though I, personifying VWAP there.
Quick question, Adam.
Oh yeah, go for it.
Yeah, I was curious. Do you strictly just do the volume during trading on the exchange, or does that VWAP include any like the dark pool trading or any of that kind of stuff, where they do volume trading back in the off the main exchange?
Sure. So I know what you're referring to. We're only looking for light or live reported volume for now. My hypothesis would really be that dark pool activity closely or nearly resembles what's happening in the lit environment. I think a common misconception about dark pools, from my understanding, having talked to many retail traders about this, is they assume that there's, let's say, better prices or some kind of, advantage that these traders are really getting. And therefore, if we knew where they were executing, we'd probably have a better understanding of it. I think in truth, it's anonymity and kind of speed of execution relative to dumping a million shares on the open market. That's why most traders go to the dark pools. In fact, I think a lot of trading that's happening on a dark pool is actually at a disadvantageous price relative to the lit market. It's just that there's much more liquidity and it can happen kind of fluidly and quickly and easily, even though they're willing to pay a bit of a premium or take a hit for it. So simple answer, no, we're only looking at the lit exchange sort of volume. But my hypothesis is that that wouldn't, let's say, differ or vary too widely. That is another good point, and I will try and follow up with you on that because I have done some research on that. So I'll make sure to pass it along, Mark.
Yeah, something I've seen in the last few days with a particular chart, it seems that the dark pool almost sits up as support and resistance, intraday and some, and maybe even a little bit longer. It just seems to be able to bounce off some of the bigger trades. So that's why I was just curious.
Certainly. Well, and I'd love to take a look. Obviously, my email and my Twitter is available on the screen. So feel free, if you want to shoot me a message with any of your research, happy to go back and forth about this. Like I said, when I appeared on Chat with Traders, I offered to connect with anybody who wanted to talk about VWAP, about trading psychology, coding, platform development, any of this. So that applies to all of you guys. Please feel free to reach out. I'm looking forward to connecting with you and answering any questions that come up. Down the road, you're implementing VWAP on your own. You're trying to get Thinkorswim to play nice with these custom studies. Anything I can do to help, please don't hesitate to reach out.